Hi folks, you must be wondering why I'm adding one more SWP video to all the videos that are floating out there. In fact, I've already put two in my channel earlier, but I thought that investors are still not very clear on the basics of SWP and this should help simplify it. So let's start with the first feature, and as we understand each of these features, then you may be able to gauge which is more suitable for you. And I've taken fixed deposits, short term debt funds, and equity mutual funds because these are the three instruments which can easily automate credits into your account. You can also do SWPs from the gold or from your stock portfolio or even from your savings account, but you have to go and take it out every time yourself. With these three instruments, it puts money into your account on designated dates that you choose. So I've taken these three as an example. So for fixed deposits, as we are aware, we give our money to the bank and they lend this out further, usually in the form of home loans, personal loans, etc. They earn interest on that and then they give us back interest. In short term debt mutual funds, it's not linked to the market. Our money is pooled by the mutual fund scheme and then it is further given to large institutions in the form of loans such as treasury instruments, CD papers, etc. And the these are typically given to banks or the government or to highly rated corporates. In equity mutual funds, our money is pooled, but they are used to buy shares of publicly listed companies. Therefore, we have to understand how stable these are. And the stability of fixed deposits is very high. We already know this from our experience. Even short term debt mutual funds are fairly stable because these our money which is pooled is being given out as loans. So they earn a steady interest and the principal repayment. The equity mutual funds are linked to the market, therefore, they are volatile, especially in the short term. So the recommended holding period for these instruments are as follows. Fixed deposits can be any period. You can hold it for a week, a month, a year, or even longer. And you can also withdraw whenever you want to. The short term debt funds work pretty much in the same way. Whereas in equity mutual funds, it is usually recommended that we hold it for 5 years or more. This is to ensure that our installments go up and down, but if the market is moving upwards, then it is largely stable after a few years of holding. So typically a longer time period is preferred for this. There's also a tax angle to this which I'll cover in a bit. Now, are there any exit loads? So when you break an FD, typically you're penalized. You don't get the interest that was promised for the full tenure. But when you opt for a scheme where you are getting back the interest, that is, you've asked for monthly payment of interest, then you will not be penalized for it. Even in debt funds, it's like a redemption which happens every month and the money is credited into your account, but they don't have exit loads. So check for a short term scheme which has no exit loads and then you can probably look for an SWP from that scheme. Whereas in equity mutual funds, there is an exit load if the installment it has not been held for 1 year. This is a typical scenario. There are some funds which allow you exit in 15 days also. There are some which penalize you if you don't hold it for 2 years also. So look at the design of the scheme, read the clauses which are related to exit load, and then you can understand this better. Now, coming to the most important part, the expected annualized returns. We know that fixed deposits at this point of time are giving about 5.5 to 6.5%. Now, in the current economic scenario and the current interest regime, this is what is expected from fixed deposits. In short term debt funds, we are getting slightly higher rates, which are roughly about 6% to 7%. But for all practical purposes, they are returning something similar to fixed deposits. In equity mutual funds, again, the expectation is that in the long term, they will deliver 10 to 12% annualized return. So, what is the rate of withdrawal that we can employ from each of these schemes? So, if you're doing a fixed deposit and you've asked for a credit of the interest on a monthly basis, then it is basically the interest for a year divided by 12. Roughly, this is how it works. We have an example also here where we can look at it. So here I select the type of customer as normal, the type of fixed deposit as monthly payout, and then the deposit amount, just for simplicity's sake, I'll put as 1 lakh, and then I choose the tenor as 1 year. So you can see here that the maturity value is 1 lakh because all the interest is being paid out. So at the end of the tenor, you will get the principal amount that you put in, but you would have got credit of the interest on a monthly basis. The rate of interest is 6.25%. The interest for the year is 6218, and the interest per month is 518. So this is how the systematic withdrawal plan or the monthly interest payment of fixed deposits work. When it comes to short-term debt funds or equity mutual funds, you have to set the amount that you want to withdraw. So in a similar way, if around 6% is your expectation from your short-term debt fund, then if you withdraw 0.5% per month, which works out to 6% on an annual basis, you will get whatever the amount that has been generated, but your principal will not grow by much. The difference between an equity mutual fund, and this is where most people are interested in systematic withdrawal plans from equity mutual funds, is that the portfolio will grow and will continue to pay you out. However, it is very important to remember that if you withdraw more than the rate of growth, then obviously the money will have to be taken out from your principal, and therefore your fund will not grow. So, the lower the amount that you set as a withdrawal rate, the more your portfolio has a chance to grow. So, here I've said that we can look at maybe 0.5%, same as FD or as the short term debt funds, or maybe up to 0.75%, which works out to 9% annually. You can also go up to 12% or higher, but this reduces your chance of growth. So I hope this is clear. This is a critical point of the SWP. Now, inflation protection is poor in fixed deposits and in short-term debt funds because the 100 rupees that we are spending today on certain items, because of inflation, we'll have to spend 104, 105, etc. So when you're earning 6% or so every year, you're not beating inflation by much. Whereas equity mutual funds has a chance to beat inflation by a significant amount. So we need to put money into equity mutual funds. Of course, this depends on our risk profile, etc. But we have to also take a long-term view on this. It's important to understand taxation as well, because ultimately we are concerned with post-tax returns. Whatever is the interest earned or the capital gains earned are added back to your income, and you're taxed at your slab rate. So if you're in the lower slab, then your taxation is somewhat better. If you're in the higher slabs, then you have to pay the higher taxation. Whereas in equity mutual funds, if you've held the installment for more than a year, you get the benefit of 12.5% as the long-term capital gains taxation. Whereas if it is less than a year, then you have to pay short-term capital gains 20%. So this goes to my earlier point as well, where the recommended holding period and the exit load, all these factors and taxation have to be taken into consideration to understand this better. The risk of capital also is a fairly important point. The scheduled banks are usually insured, so if something should happen to the bank, up to 5 lakhs of your money is protected per bank. The short-term debt funds are risky because there is a chance that one of the companies to whom they have lent may default, and therefore part of your money may get stuck. But if you stick to lower credit risk and lower duration risk funds, then you are safer. The equity mutual funds in the short term, as I mentioned, are volatile, so therefore the capital risk is high. The longer you give, the more likely you are able to see a stable return from it. However, you have to be careful. You have to monitor this quite constantly and make sure that you are managing your funds to that extent with regard to market fluctuations. Therefore, to summarize, all three are suitable for systematic withdrawal plan, but these are ideally suited for fixed deposits and short term debt funds are suited for short to medium term, that is less than 5 years kind of cash flows if it is required. If you held your equity mutual funds for more than that, then you can look at them for systematic withdrawal plan. And importantly, remember that the lower your rate of withdrawal, the more your portfolio has a chance to grow. So I hope this has added clarity to your thoughts on systematic withdrawal plans. If you have any queries, please do drop a comment or write into us and we'll be happy to get back to you. Thanks for watching.